All right, I'm going to go ahead and just jump right in. So, my name is Jason Kojak. I'm excited to do this lunch and learn through NC State's continuing and lifelong education, and we do these from time to time, basically to kind of help us kind of share information and give you some helpful tips. So today we're going to do all about residential cash flows. Okay. And so I want to kind of start here a little bit about myself. I'm not going to go through all of this, but I have long record of doing real estate sales. I've been in real estate brokerage for almost 25 years. I have done investment consulting. I do that on the side. I'm an adjunct professor over at State, where I teach applied real estate economics as well as financing and investing. Um, I also have written a book, Plug the Holes, Fill the Barrel. It's on Amazon. It's all about residential. And then I do a lot of teaching for the Real Estate Commission with continuing education, as well as through NC State through their continuing and lifelong education. So I've done a bunch of different stuff here and excited to kind of get into cash flows. Quick basic disclosure, as you could imagine, we have. We're going to talk a lot about numbers today. We're going to talk some about taxes and a lot of different things. And obviously, as we talk about those things, it's just important for you to make sure you're getting outside professional advice, especially on the tax and the legal. Those things are so unique to everybody that I just want to make sure that we're giving you that kind of that fairness to make sure that you're talking to an accountant or your tax professional. So with all that fun stuff out of the way, let's just dive in. Um, First thing I want to kind of go over, and this is something that I've learned through all of my investing, is the first thing you need to do is kind of have a plan. And if you've ever taken any of my courses in the past, you know I'm a big believer in this. So I'm just going to take 30 to 60 seconds to go through this real quick before we dive into actual cash flows. Any investor I've ever worked with, whether it's a mom and pop who owns one or two rental properties, or it's somebody that maybe owns a tremendous amount of properties, they always have really clear cut goals of what they want to accomplish. And a place that a lot of novice investors kind of get hung up is they don't have any clear cut goals. And so when you don't have a goal, you have a tendency to not be able to measure success per property. And when you can't measure success per property, what you end up doing a lot of times is either buying the properties that aren't suited for what you're trying to accomplish. Or the flip side of that is you just keep buying more and more properties, you get more and more leveraged, and you really don't know if it's a success or not. It may look successful on paper, but it may not feel successful in your wallet. And so there's three things that I always encourage people to have a kind of internal conversation with themselves before they get into this business. The first thing is understand, what are you really trying to accomplish, right? A lot of people chase money, right? Obviously, we all kind of do that. But really, what most people want in their life is the ownership of their own time. I do it. I do this all the time. I sell my time for money, right? Everybody has a job. They sell their time for money. And really, what we're trying to accomplish is retain our time ownership. Real estate can be a really big, helpful thing to help you get that ownership back. But it needs to be done correctly and it needs to be done set up with goals. So the first thing is understanding really what are you trying to accomplish? Just more money or ownership of your time? Most people are trying to get ownership of their time. The second thing is to understand is that, is money my goal or is money simply a tool? One of the biggest things I think people get confused on is they associate money as their end goal. And really, money is simply a tool. I kind of use the analogy, if I sat a dollar on my table and I sat a dollar on Jeff Bezos' table, at the start, that dollar is the same, right? It's just what that person does with the dollar that makes the difference. So a lot of times people end up chasing more dollars instead of learning how to use those dollars effectively and efficiently. And the sooner you can learn how to use that dollar more effective and efficiently, all of a sudden you realize maybe I don't need to chase as many dollars and therefore I can get some of my time ownership back. And then the third thing that's really important is, do I want to be rich or wealthy? I'm just going to talk about this from a financial sense, but rich in my mind, means that I have to continually sell my time in order to go and get money. Wealthy means I own my time and I'm still getting paid. And so when we look at real estate as an investment strategy or as an end game, most people are trying to accumulate wealth where they can own that time and still accumulate some income. And so I just want to give that quick base. I'm not going to, like I said, dive into it too deep because today we're here about cash flows, but I want you to really think about this as you get into this game or you expand. What am I really trying to accomplish? And then that will help when you dive into what kind of properties. So here's my investment flow chart. This is what I do anytime I consult or I teach or I talk to a potential client, or even when I'm going to go purchase a properties. There's preparation. There's setting up our financial goals. We kind of just briefly talked about that. There's our investment thesis, and there's our financial options, right? So our preparation really doesn't have anything to do with the house itself quite yet. Then we have implementation. Okay, what is my debt selection going to be, right? My loan, what kind of loan? And what is my tax strategy, right? And what tax elements am I going to incorporate into this particular property, and what's the benefit there? The actual property selection, and then cash flow analysis. We're going to go through that today. And then on the far right, what is my management and my exit strategy, right? So how am I going to manage the tenant? Am I going to manage it? Is somebody else going to manage them? What kind of rental is this? Is this a long-term? They're going to stay in there for a year or two. Is it a short-term rental? What kind of rental are we going to do? What is our value add strategy? We're seeing this really big right now. As the market is kind of softened, it's great for buyers, great for potential investors. However, I would really suggest that you have some sort of value add strategy to each property, even if you're not going to sell it for a very long time. And then again, what is our actual exit strategy, which a lot of times links back to our tax strategy or our estate. So again, today we're going to focus on cash flow analysis, but I just wanted to show you kind of this brief investment flow chart. At the end of this, I'll bring it up again and we'll talk real quickly about how to learn about other parts of this. So cash flow elements, okay? I'm going to just put these all up on the screen here at one time, and I'm going to go through them, okay? So pro forma cash flow. So a pro forma, we use that in commercial real estate, but really it's just a breakdown of the estimated numbers. So let's go through what items are going to arise inside of your cash flow for the residential. So the first is going to be top line revenue and reimbursements. Okay? Just obviously what is coming in, right? Then we're going to have our effective gross income. Our effective gross income just kind of takes out our vacancy and some of these things that we don't know what will pop in, but we know they may pop in, right? And then we're going to have operating expenses. Our operating expenses are just our day-to-day operations. That is not our mortgage, okay? That is just day-to-day operations. Could be property management fees, property taxes, repairs, all of those things. That's going to kind of get us down to our net operating income. In commercial real estate, we use net operating income all the time. And in residential, a lot of times investors just look at the very bottom line. And I would suggest that you start to learn how to operate this almost like a commercial building, simply from the fact that it's run a little bit more like a business and helps you find your inefficiencies as well as how to add to your revenue. And then we have our debt service. Another fancy word just for mortgage, right? What is our loan amount? And then we have our CapEx reserves, or our capital expenditures. Those are those things that happen every couple years, usually pretty big ticket. And we may actually what we call depreciate those items. It could be an HVAC, a hot water heater, a roof, kind of those common items. And then we're going to also talk about some added things today, since we'll have a little bit of time here. Straight line depreciation, right? How do we depreciate this property? You've probably heard about that, but you may not know exactly what that means. How do we get to our taxable income? What is the IRS going to make us pay? Then our actual taxes, then our after-tax return, then some return calculations. So we're going to go through all of that today. We're going to go through it relatively quickly. You will get these slides that'll be emailed out to you. And I teach other courses. I'm happy to kind of dive in a little bit deeper. So let's just do a sample property from A to Z, start to finish. That's usually the easiest way to kind of teach this. So 123 Main Street, we're going to purchase it for $400,000. We have our estimated rent of about $3,000. We have estimated property taxes of $2,500. We have property insurance of 1,200, maintenance and repair 500, repeating expenses 200, property management fees 2,184, HOA dues 1,200, miscellaneous 200. That's that stuff that's just kind of weird that maybe doesn't pop into a specific category. Okay. Now, one thing I want to make sure that we're clear about in today's lesson, we're just looking at how to run this cash flow. We're not talking about how to research these items. That would be a longer kind of course where we would say, okay, how do I estimate what my insurance is, or how do I estimate what my maintenance and repair are? We're doing this cash flow based that we know these numbers or have a good estimation of what it is. Our financing, we're going to do a 75% loan to value, which means that we're going to have a 25% down payment. So 25% on 400,000 is going to get us at $100,000 as a down payment. So that's our cash in. We're looking at a 6% interest rate. When I put this slide together a couple of weeks ago, rates were at just about 6%, actually. They're about 6.4 today. They fluctuate, right? So we bob and weave as the market conditions kind of give us. 30-year fixed. And that's kind of our, let me just go back one slide. That is our overview, okay? Again, if you're doing this at home or you want to use a property that you have as a rental or even test it on your primary residence, hopefully you can get most of these numbers with relative ease, okay? All right. So now let's look at that top line revenue, right? What is our gross potential income? So I have a note here that everything starts with the top line, right? So if you're off on the top line, everything else is going to be off. Most investors will look at rental income from a base, best, worst case scenario, meaning, hey, look, what is the median? What do I think I can rent it for? But gosh, man, what is my worst case? Worst case could be I'm renting it in November or December, right? When we're slower. Worst case could be, wow, there's a lot of rentals on the market at the same time as mine, and I didn't expect that, right? So what's that number that's going to be competitive? And then best case could be a variety of items as well. So we're just going to use $3,000. I have in there $0 for reimbursement. The reason I put that line item, even though it's zero, is because there are certain circumstances where you may get a reimbursement from your tenant. Some people charge monthly pet fees instead of a one-time pet fee. So that would be a reimbursement. I know some people that do the landscaping for their rentals, and they charge the tenant maybe a $25 a month landscaping fee. And so there are certain times, although not very often, that we will have a reimbursement. So I have a total monthly of $3,000. I times that by 12 months, and that's $36,000. Now, I have not talked about vacancy or anything like that. This is just gross potential. So potential tells us what is the potential of this property, and we're looking at it from 100%. I have a little pro tip as we go through this on a lot of the slides on the left-hand side that I think are important. So I have here, most novice or sometimes unrealistic investors will overestimate forecasted rent growth. I see this very, very common. We still see it in commercial properties all the time where I say, oh, I'm going to rent it for $3,000 this year. And I'm expecting a 3% jump in rent for next year, meaning next year, I'm going to get $3,090. We see those continual increases factored in as people forecast forward. And I think a lot of times they do themselves a disservice because they maybe don't fully understand the economy, or they just assume the rental increases will always happen. If you're investing in real estate, you should have a good pulse of the economy, supply and demand, and your local hypermarket in regards to rent before you start just adding automatic future increases, okay? So that's kind of my pro tip for gross potential rent. Now let's look at vacancy and bad debt. Okay, and I'll explain what both of those are. So again, we've got our $36,000 of gross potential. Now we want to say, but what is our real effective, right? What are we effectively getting out of that 36,000? So vacancy, we put in, a lot of people are going to use anywhere. I've seen it as low as 5%. I'm not a fan of 5%. I've seen it as high as 10%. I would use 10% if maybe, where my property isn't a great location. It's not a class A location. It's maybe a class B location. And it maybe takes me a little bit longer to rent it. I may use 10%. Most professionals are going to hover somewhere in that 7% range. Okay. So we put in 7% there. It equates to just about a month. And then we have bad debt. What is bad debt? Well, we know what vacancy is. Okay. I had tenant A leave and I'm waiting for tenant B to move in, and it takes me maybe a month or so to make that happen. Bad debt is the tenant that is already in your place that just can't pay, right? Just, hey, look, I'm a tenant. I have 8 months left on my lease. And for whatever reason, I can't pay rent. Could be obviously obvious things like a loss of work, loss of employment. Could be maybe, gosh, I had a medical emergency, right? People go through separation or divorces. There's a litany of things that just when life happens. That's usually a smaller percentage, but we still factor it in, right? In best case scenario is it's leased for 12 months. I don't have any real vacancy in that year, and everybody pays on time or at least pays completely, and I don't have that. But you'd be an irresponsible investor if you didn't factor some of that in. And I see a lot of investors who don't factor that in. So that gives us an effective gross income of 32,760. So that's going to kind of be our new top line. Okay. And then my pro tip for this is, estimating accurate vacancy and bad debt can be critical to your income. It's hard to do the bad debt. That is a crapshoot for some, to kind of get accurate. But your vacancy is really supply and demand. You have to know your competition. You have to know how many other rentals are on there. You have to really have a pulse of the market. And that's a pulse of the market for each and every property you own because they may not be in the same neighborhood, right? So this is a really important thing to understand. Again, as you're training yourself to do the cash flow like I'm setting it up, you're also training yourself to understand a little bit of commercial real estate in case you ever dabble in that. Next, we're going to go over our operating expenses. Property taxes, right? So most of us, if we own a house right now, we know where we can find our property taxes and that type of stuff. Where it gets tricky is forecasting what our property taxes are going to be for next year. I personally live in Wake County in North Carolina. And so it can be tricky. I don't know what my property taxes are going to be next year. And if you look for the past couple of years, it gets even stickier, right? Tax bills have been all over. But that's going to be a massive chunk of your day-to-day operational expenses. Repeating services, again, it could be landscaping, termite, pest things, stuff like that. As a landlord, you kind of have an option. You can be let me go run as slim as possible on my operating expenses. I'm not going to have a termite or a pest inspection unless somebody says, hey, I think I found a termite, right? Or I'm not going to replace the mulch out front every 2 years. And you can run really, really slim margins that way. It's been my experience, and again, I've been doing this almost 25 years. It's been my experience that I actually go on the heavier side. I make a little bit less cash flow on a monthly basis, but my properties are always in really decent shape. And that does two things. One, it allows me usually to get a better qualified tenant who will pay a few extra bucks a little bit quicker every time I have a turn because the property is just in good shape. It also gives me less headache and less kind of uh-oh moments that I can't expect. And the third thing, and I learned this during our 2008, global financial crisis, is that you never get to pick the type of market conditions you may sell in. And so, unfortunately, sometimes you have to sell in a tough market. And if the house is always maintained in well condition, what that ends up doing is that if you do have to sell into a poor market condition, your property is usually already in good shape. You've been slowly taking care of it and maintaining it. And that way, when you go to sell it in a down market, you don't have this huge capital expense where you got to fix the property up and do a bunch of maintenance stuff that you didn't do. So again, some people will just want to maximize the monthly cash flow. That is their end game. They don't care really about the maintenance of the property. I have a different take on it, right or wrong, who knows? But again, a lot of experience comes behind that. Management fees. Some people, especially when they start kind of, I call it a mom and pop investor. I consider myself still a mom and pop investor. I do a lot of self-management, which is great. The one thing I would always encourage you to do is inside of your cash flow, still have a property management fee. Again, if the only way this property works is that you can't hire a property manager and pay that fee, you just don't know what life is going to throw you. You might get a job transfer, et cetera, right? And so you might want that management in the future. And sometimes novice investors have a tendency to just slice and cut things out to make the numbers work. And then they get into it and they realize, oh gosh, I wish I hadn't sliced that out because I actually need it. Miscellaneous HOA dues, kind of common sense there. Obviously, always check. Again, this is not for the topic of today, but always make sure you're checking your HOA rules, allow rentals, understand all of that. Maintenance and repairs. Hey, look, this can vary greatly based on the age of the systems, the quality of the maintenance, cost of labor. A lot of times investors will want to correlate it to the age of the property. It's not necessarily the age of the property, it's the age of the systems, right? I could have a house, I've got houses that are 40 or 50 years old, but the roofs are 3 years old, the HVACs are 4 years old, it's been repiped or had new electric or whatever the circumstance may be. And gosh, those houses are in great shape and they're, 40, 50 years old. And I also have some newer houses where maybe they have, 5 or 10 years and we have these systems that are aging. And so I'm going to have a bigger expense on those. So understanding the property and really, like I said, trying to get it in decent shape when you kick off is going to be a huge help. And then insurance. Well, we've seen insurance all over the board. If you own a property, even just your own residence, my guess would be in the past couple of years, you've seen property insurance spike. A litany of reasons, again, not for today's topic, but understanding property insurance is huge in this industry. You have liability when you get into owning other property that other people are staying in. And you have certain things that they do cover and don't cover and deductibles and all of this other fun stuff. But understanding your property insurance and how those premiums may increase over the course of time is fine. Because remember, we're doing a cash flow today based on today. However, we're planning on holding this property probably for a while. So your ability to forecast into the future will be another step that will really separate you from being able to grow and purchase more properties and be successful versus the other group that says, wow, I bought this house, it rented great for 2 years, and then all these expenses went up, and now I don't like the house anymore. I don't like real estate anymore. And it's really on them, right? It's a lack of forecasting that put them in that situation. All right. So now we have our effective gross income, right? We have our potential gross income. We took out our vacancy. We took out our potential bad debt. That put us at 32,760. And now we're going to deduct all of these just operational expenses. Again, we don't see any mortgage payment in here yet. We are just trying to get to our net operating income. Okay. NOI, as it's called, is used in every commercial deal you'll ever see. It's very rarely used in residential single family. And that's usually because residential operators or residential investors have a tendency to dumb down these numbers. They don't need to be complicated, don't get me wrong. But they usually have some sort of training in just the residential, have never had any exposure to the commercial. And again, most investors kind of focus on residential or commercial. I'm lucky enough and fortunate enough to be in kind of both worlds. And so I've really incorporated some of the commercial structure into how I run a cash flow. So it looks more professional. It looks better to a lender, right? When I go to get a mortgage and they want to know my profit and loss or how the properties are producing, you send them, my type of cash flow like this versus, maybe a mom and pop, you're going to see a much higher rate of approval for mortgages and growth and those type of things. And so again, NOI, the beauty of NOI, net operating income, is that what we're doing is we're seeing how just the property performs, just the property. As soon as I add in a mortgage payment, that means that mortgage payment was unique to me. So in this example, I had a 6% interest rate and I put down 25%. Well, what if somebody else down the street had purchased that same house and they had 6.25% interest rate and they only put down 20%? They put down 80,000. Well, their mortgage payment is going to be different. And so as soon as I add that mortgage payment into these numbers, all of a sudden I've taken the individual property and how the property is performing, and I've put my own personal situation in there. And that messes up and skews the number for the next user. And so I would strongly suggest that you come up with your net operating income. And that is how you're evaluating the property at this level. What is the property producing? Irrelevant of what kind of debt service or personal situation may come into this. So again, NOI, really common in this situation. When you take our effective gross, we remove all of our operating expenses, and we come up with a $24,339 net operating income. Okay. Now we're going to talk about our debt service. So our debt service, again, I use the phrase debt service, and that's simply just kind of a little bit more of a commercial term. And as I go through this, even though we're doing residential, I'm trying to give you all a little bit of insight to just a tad of commercial. So when you speak this language and you talk to lenders, even on a residential side, you just sound like you have a little bit more experience, and it kind of can help you move along through this process. Okay. All right. So net operating income, 24,339. So now we're going to look at our mortgage payment. So on a debt service of 300,000 at 6%, we're going to have a principal and interest, what we call a P&I of 1799. Remember, we already took care of our property taxes. We already took care of our HOA dues. We already took care of our insurance in the previous segment to get to our net operating income. A lot of investors, especially on the newer side, will use their full mortgage payment, which has a tendency to have property taxes, insurance, et cetera, escrow, right? You pay a big payment, all of those things get delineated out. As soon as you do that in your cash flow, you have once again brought your personal situation and your personal mortgage into the cash flow. And it's a different way that it's being evaluated. So I take out those property taxes, I take out that insurance, even if my payments are escrowed, and I put them into my operating expenses. That is where they should land on that previous slide. Now, when I'm talking about my debt service or my mortgage, I'm strictly talking about my principal and interest, and that is just what is unique to me. Now, if you take the 17,900 and you multiply it by 12, that gets me 21,584. That is my total principal and interest. Now, we will discuss here shortly how we take the principal part out of that, right? That gets into a tax thing. But for right now, we're just looking at about 2755 in cash flow. We don't talk about it in today's lesson, but I do talk about it in other classes about having different types of loan structures. Most people come into this with the viewpoint of their primary residence and how they've done this. And the reality is that we have to look at it through an investor lens. So one of the things that I really try to teach people is how do we evaluate multiple loan options from the investment side that line up with those goals that we briefly talked about on the first slide today. All right. So now we're at a point that we can talk about, here's our annual cash flow, just cash in my pocket. Real simple. It's not what our taxes are going to be based on, but it is just actual cash. So this house right now would land me about $2,750 in my pocket. So now we need to talk about some of these kind of extra things. And this is where novice investors have a tendency to get a little shaky, okay? And I'm going to hopefully try to help you out with that. So the first thing we need to talk about is going to be our CapEx, okay? So here you can see on the left-hand side, we talked about our OpEx, our operational expense, right? And that came from our effective gross income. We took out all those day-to-day operational expenses, and that got our net operating income. Now we need to talk about our CapEx, our capital expenditures, okay? And our capital expenditures, I have a real kind of brief summary here on the slide here, but you need to be saving for every property you own a certain amount for each of the large items. Now, the tricky part is that I might have property A that's got a roof that's 3 years old, and I may estimate my roof is going to last 7 or 20 years. So I have 17 years left to save for that new roof. I may have another property that's got a 17-year-old roof on it, and I have 3 years to save. When you purchase that property, right, understanding the age of those systems is critical because, again, if I purchase a house with a 17-year-old roof, if I had only 3 years to save for that new roof, it's going to demolish my cash flow. It doesn't mean I won't buy the property. It just means I need to be prepared for that, and I may try to squeeze harder on my negotiating, right? But let's say I have an idea of what my future roof is going to cost, I want to save $900 a month, okay, for this potential roof. So that's, or excuse me, $900 a year. So that's $75 a month. Let's say I've factored in that I need to save $600 a year for my HVAC, that's 50, et cetera, et cetera. That gives me a total annual CapEx reserve of 1,800. Now, please notice I use the word reserve there. The reason I use the word reserve is because it is just that. It is reserved to the side. And that's really, really important to understand because even though I'm taking $1,800 out of my numbers, the IRS says you haven't spent that 1,800 yet. So I'm still going to get taxed on the higher number until I actually spend that amount. Because of that, a lot of novice investors will underestimate their CapEx because they say, well, gosh, once I save the CapEx and I set it to the side and I'm paying taxes on the higher number, it really destroys some of my cash flow. And I would encourage you to kind of ignore that fact and make sure that you're saving for your CapEx. The sheer number of investors I work with, and even regular homeowners for that matter, in my general brokerage business, that want to sell the house right before the roof is dead, or sell it with a 22-year-old HVAC, or any of these things, you're discounting the intelligence of the next buyer, right? You're just making the assumption, oh, I'm going to squeeze out, and the next buyer is not going to care. Don't get me wrong. A couple of years ago, the market conditions existed for that, where you could sell a house with a hole in the roof almost. That's not today's market. And so make sure you are saving. As you grow your portfolio, okay, so as you get to, we'll call it 5 properties for ease. When you get to 5 properties, you can start to probably slow down on a large saving for your CapEx. And the reason you can do that is because there does come a certain point in time where you have such a large reserve that it's hindering your ability to use that cash to deploy and invest further, right? And so, for me, I won't give you specifics, but for me, if I have somewhere in the range of 10,000 per property set aside, that makes me feel like I can weather a good amount of storms from a CapEx perspective. And if I had 10 properties, I don't know if I need 100,000 sitting to the side, right? I might say, gosh, when I get to 50,000 set to the side, even though I own 10 properties, that's probably enough, because the odds of me having multiple crisis or multiple CapEx at one time is a little bit on the lower side. So again, make sure that we're saving for that CapEx. And I have a note here, many investors, both residential and commercial, underestimate their CapEx. They really do. And can be, like I said, this can be a dagger. You won't necessarily notice it in your cash flow day to day. You will notice it either when you go to sell it and you have all these large items that hurt the value, or when you actually go to replace that roof or that HVAC, and somehow you have to charge it, or you have to take mechanics debt from the vendor, and you're paying 12% on a roof that's already inflated with supplies and materials. You can just shoot yourself in the foot. All right. So that kind of talks about CapEx. Now, the next one is depreciation. And we're going to start getting into this tax thing here. And I want to make sure, again, I just reiterate, talk to your accountant, right? I'm going to show you the most common residential way that properties are depreciated. But there are multiple ways to do this. This is not the only way. First, let me just explain real quick why we depreciate a rental property and we may not depreciate a residential. So the IRS says that you have to put a property into service in order to depreciate it. So I go buy a pickup truck just because I want a pickup truck. I'm not depreciating that because it was never put into service. However, if I buy that same pickup truck and I own a construction company, because I'm using that truck in the course of business, that means it was put into service, I can depreciate it. It's the same thing with real estate. My house that I live in, I can't depreciate because I haven't put it into service. There are some caveats there, again, not for today. But if I go buy a rental property and I have a tenant in there, from a business perspective, I have put it into service, which means that it at least checks that box to qualify for depreciation. Now, one of the places that people really get kind of confused on depreciation is how do I come up with this value and how do I do that? And so I'm going to kind of tell you a couple quick things. The the main thing to understand is that for all intents and purposes, we don't depreciate land. We may depreciate something we do to the land. I may add a pool, and so therefore I may depreciate my pool, but I'm not depreciating the dirt around the pool. And so the way that I describe it in my classes is if you're at your house right now or you go to your house later tonight, if you were to go out in your front yard and dig up a bucket of dirt and you sat that bucket of dirt just in the bucket for a whole year, and then you go inside your house and you take a 2x4 out of the wall and you sit that 2x4 on the ground for another whole year. When you come back in a year, that bucket of dirt is still a bucket of dirt. It hasn't lost any value. But that 2x4 is certainly worth less, right? It's a year old. And so in real estate, according to the IRS, we are allowed to depreciate those items that do have a expected life expectancy. So real estate, the physical part of real estate, the building has an actual expected life, whereas dirt doesn't. The tricky part is that when we bought this house for 400,000, okay, we didn't tell the previous seller, hey, we're going to give you $300,000 for the building and $100,000 for the dirt. And they said, okay, that's good. We said, we're going to give you 400,000 and we want the building and the dirt. We didn't do any breakdown. Nobody does. But now that we're in our investment cycle, we need to do that. So the easiest way to do this is we use the local tax assessment. And in essence, I live in Wake County. I know we have a couple hundred people on here, so they live across the state. If you go and you look and the IRS, or not the IRS, excuse me, your local tax assessor, basically says, hey, we think your total house and land is valued at 400,000. That's your assessed value. And we think that of that amount, $100,000 is the dirt and $300,000 is the building. Okay. All I want to use is that ratio. And that ratio is that they are saying 75% of their value is made up from the building and 25% is made up by the dirt. Now I can take that ratio, 75% for the building, and I can multiply it by what I purchased for. Now, in that example, it's the same as what we purchased it for. But had I purchased this house for 500, I would take that 75% and I would multiply it by the 500,000 I purchased. And that now gives me a cost basis. Again, please understand, I said cost basis. It didn't say purchase price. We are going to take the percentage that the tax assessor gives us, usually online, where they break down the land and the building. We're going to just take that proration and multiply it against what we actually paid, and that will give us our cost basis. Are there a variety of ways to do this? For sure. I can hire an appraiser to do it and pay him $500. But this method is free, right? Could I do a cost segregation study? For sure. But this method is free. So most mom and pop investors, they end up using this method for depreciation. Okay. So in this circumstance, I am using the $320,000 for cost basis. Remember, purchase the house for 400,000. I am making the assumption that my land is worth 80,000. So I remove that 80,000. I now have a cost basis of 320,000. The IRS allows us to depreciate residential real estate by 27.5 years. Okay. So 27.5 years. I take that 300,000. I simply divide it by 27 and a half. And that means that I am allowed to take an allowable depreciation expense annually of 11,636. Again, could I use other depreciation methods? Of course, right? There's just a variety of ways you can do this. And this is why the CPA becomes really important. With the big, beautiful bill from January, we have bonus depreciation. We have all of these different things. It's an evolving tax structure. But this is the most common. And so this is the way I'm teaching for today. This is what the average person would do. So I have an allowable depreciation expense of 11,636. All that means is the IRS is saying, hey, Jason, you put that property into service. And because it's going to get used and abused, just like your pickup truck might, we're going to go ahead and let you deduct what we think the value is every year. The crazy part is in real estate, usually the values go up, and I'll explain what that does. Okay. So now we have taxable income. So what is taxable income? Okay. So we have our net operating income we've already discussed, 24,339. Now we're going to deduct our debt service interest only. Now this is important. When we took that payment of, I believe it was $17.99 a month, and I multiplied it by 12 months, I think we ended up somewhere, I'm not going to go backwards, but I think we ended up somewhere in the 21,000 and change. That was principal and interest. The IRS only allows us to deduct the interest part, which means I have to remove the principal. And the reason that the IRS does that is the IRS says, look, the principal is a benefit to you. It's not an expense. You may have paid it all in the same payment, but it's a benefit to you. And even though you may not realize that benefit until you sell the property and the mortgage amount that you owe has been lowered every single year, hey, nonetheless, it's a benefit. And so you're not allowed to write that off. So you can see here where I have next the debt service interest, I wrote not principal, interest only, right? That's what the IO stands for. So I'm not writing off 21,000. I'm writing off 17,900 in interest. And then I take that depreciation and look at that. I have a taxable income loss of 51.97. Well, that's crazy. I thought we made 27.55 in cash flow, which we did. But then out of that 27.55, we took 1,800 and we sat it to the side for CapEx, which we did. But now I'm going to tell the IRS that I lost almost $5,200, which I am. All of those things are true at the same time. And this is where having a really good and detailed cash flow can help you and your accountant, because multiple items can be true inside of this cash flow. Now, a tax savings, if I'm at a 25% tax bracket, would be almost $1,300. Now, let's talk about some of these things, okay? The first thing, the very first thing is that I have right there. Do not take this as tax advice. I can't stress that enough, right? Everybody's situation is totally different. But just because you see a loss, that taxable loss that we have there of what, 5,200 bucks, it does not mean you can actually take that deduction this year. You might be able to. But a lot of times the IRS is going to consider that real estate as a passive income generator. My accountant calls them pigs, passive income generator. And so that means that any loss, any paper loss that I'm taking can only go against passive gains. So if I sold some stocks this year and I made $10,000, I could offset that $10,000 with that $5,200 of a loss, and I would pay less taxes. But if I didn't have any gains and I just have a loss, those losses may have to roll forward until future years or until I sell the property. Again, there's very specific IRS rules on who can take the loss, when they can take the loss, what income bracket you're in, blah, 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 blah. And so you may have a loss, but you may not be able to take it that exact year. The good news is they don't go away. It just may roll forward, okay? There are some exceptions to the previous rule. I kind of briefly talked about that. I do have a note here that depreciation is the main reason that people will take a paper loss, right? That's a big amount. But here's the thing, and this is where, again, a lot of novice investors get a little kind of tripped up. We have something called depreciation recapture. So what is depreciation recapture? Well, let's go back to that pickup truck example. I buy that pickup truck from my construction company. I buy it for $60,000. I slowly depreciate it. And after 5 years, maybe I say on paper, it's worth $45,000. I paid $60,000. I've depreciated it on paper down to $45,000. And I want to get a new truck. So I sell that truck and I end up selling it for $35,000. So bought it for 60, depreciated it down to 45, sold it for 35. Okay. I sold it under the depreciable base. So that's perfectly fine. I don't owe any of that depreciation back to the IRS because, in fact, I sold it for less than what it was depreciated to. Not so fast on real estate. Let's say real estate, I have that $400,000 house. I depreciate it down for a few years. Remember, writing off $11,000 every year. So let's say I hold it for 5 years. I wrote off $55,000 in depreciation. And that puts my depreciable base at $345. I purchased it for $400. I wrote off $55,000 in depreciation over 5 years. That means I'm telling the IRS it's only worth $355,000. Well, 5 years later, that house is worth $450,000. So I sold it for well more than what the IRS let me depreciate it at. Well, you all know the IRS as well as I do. The IRS isn't going to let that fly. So the IRS is going to say, hey, all that depreciation you took for the last 5 years, because you sold it for more than what you depreciated it to, we have something called depreciation recapture. And that means that a good portion, if not all of that depreciation you took, when you sell that property, is going to be added back to your income. You're going to have to pay taxes on the very thing you wrote off. Now, many times it might be a wash. You may have saved it over the years and you pay it back then. And there are some tax strategies. Again, we're not going to talk about it today. The two main tax strategies would be something called a 1031 exchange. And the other is sometimes people will just pass it through an estate and the depreciation goes away. Again, not for right now, not for today's course. We teach that in other courses, but I do want to explain that because a lot of times people will brag about depreciation and how great it is, and it can be amazing in real estate, especially if it's structured right. And then they don't ever talk about depreciation recapture, and that can be a real surprise. Now, approaching the end here, let's get to I'm going to pop these all up since my PowerPoint doesn't want to cooperate. Let's talk about a couple quick calculations that I just want you to understand. Now, these are going to be blended between residential and commercial. And again, as I told you, I'm trying to give you the real influx here of both sides. So cash on cash, what is our annual pre-tax cash flow by our cash invested? So in this circumstance, we might use that 2755, right, that we got on an annual basis divided by the 100,000 we put in. We have our cap rate. You see this all the time in commercial. You don't see it as often in residential. The reason you don't see it that often in residential is because most novice residential investors don't separate the net operating income like I showed you. And so they can't do a cap rate because they don't have a net operating income. If you follow this method that I gave you here today, you'll have a net operating income. You divide it by your purchase price, and there's your cap rate. Internal rate of return, not going to go over that today. It's a little bit more complex. It's really not complex. It's just a little bit more complex for today. But that is basically how we look at returns, but with a time value of money. A little bit different than an average. We put a little bit more weight on when I receive my money. We have an equity cash flow here, or excuse me, equity multiple. And then we have a return on investment and we have an after-tax return, okay? And so these are 6 basic calculations that if you run the cash flow exactly how I have told you how to run the cash flow, you will be able to go ahead and do all of these calculations really easy, really, really easy.